As many of you are aware, Pilbara has undergone a period of rapid growth and transformation over the past 5 or so years. From an operational perspective, this commenced with the construction of the Pilgangoora plant in 2017 and first shipment of ore in FY19. Next was the announcement of the P680 expansion project FID in 22 and completion of the primary rejection facility in 23. In 24, the company finalised construction of the P680 crushing and ore sorting facility, as Dale mentioned earlier, and in 25, the P1000 project will be completed. Most recently, we also announced the acquisition of Latin Resources, the company's first international expansion project. The company's operations have expanded and matured significantly. The company is also maturing its support functions as an enabler for our growing operation and business more broadly. This includes maturing the company's balance sheet and access to debt capital markets. The company has transitioned from a business that was originally equity funded, like many development projects, to the current government-led project-style facilities established in 23 and drawn to approximately $368 million as at 30 June 2024. Today, we're very pleased to announce the next step in the maturity of our capital structure, being a more flexible and more efficient corporate debt facility. The history of Pilbara has been one of disciplined and prudent management of our balance sheet. The new debt facility we have announced today is the next logical step in that journey and as the company matures. Turning now to slide 16. Today, we announced that the company has received commitments from a group of domestic and international banks for a proposed new $1 billion debt facility in the form of an RCF. This new debt facility is being established to refinance our existing project-style debt facilities on improved terms while further increasing our financial flexibility and liquidity. Relative to our existing drawn debt facilities, the proposed new debt facility will increase our liquidity and enhance financial flexibility, provides an additional funding source for growth initiatives subject to market conditions, has competitive pricing and is expected to reduce financing costs relative to the existing facility, has a favourable covenant framework, provides flexibility to put in place project-level debt and other unsecured debt, and finally, significantly strengthens Pilbara's institutional banking relationships with strong support from a group of blue-chip domestic and international banks for this $1 billion of new debt. Turning now to slide 17. To reaffirm our prudent approach to capital management and maintaining a strong balance sheet, we're also making an adjustment to our previously announced capital management framework to include a target leverage ratio. We've set a target leverage ratio of less than 1.5 times through the cycle, which will guide our approach to leverage and balance sheet management. This target leverage ratio serves to reinforce and define our commitment to maintaining a strong balance sheet through the cycle. Importantly, it's also set at a level which provides a significant buffer to the leverage covenant applicable in the proposed new debt facility. We also note that our target dividend payout ratio is unchanged at 20 to 30% of free cash flow, subject to prevailing market conditions and board discretion. As outlined in our capital management strategy, Pilbara Minerals will continue to prioritise its capital allocation, firstly to maintaining safe and reliable operations. Secondly, to investment in the P680 and P1000 expansion projects to maximise operating efficiency and cash generation from the operation. And finally, any excess cash flow will be allocated to a combination of maintaining balance sheet strength and the payment of dividends through the cycle. Today's announcement is another exciting step in the maturity of our company. The new $1 billion debt facility is an indication of our company's strength in the external market and will further strengthen our company relative to our peers by fortressing our balance sheet even further. With today's announcement, we also confirm that we will continue to manage our balance sheet in line with our track record of being thoughtful and prudent.
And our next question is going to come from the line of Hugo Nicolaci with Goldman Sachs. Your line is open. Please go ahead.
Morning, Dale, Luke, Sandra and team. Thanks for the detailed update this morning. Just first one following on from Kate's question on the new debt being put in place. Can you just give us a bit more colour on how that was sized and how much of that you see as, I guess, preserving that optionality for other opportunities versus the main driver being more about liquidity and repaying existing debt whose covenants, I think, get more restrictive at the end of FY25?
Sure. Thanks for the question, Hugo. So in terms of sizing, what we looked at was our through the cycle downside and upside scenario modelling to work out what would be an appropriate level of access to liquidity for the business. That was the first point. Secondly, we already have or have had $400 million of debt in place, and we wanted to upsize on that fairly materially. And then lastly, in a price environment of, let's call it $1,100 a tonne as the average realised price over FY24 and $500 million of EBITDA, having a facility that had sort of 2 times EBITDA of limit also seemed appropriate to us. I would note that we were very pleasantly surprised by the demand in the bank market to support us, and the $1 billion was well oversubscribed. But for us, this is the size of facility that we think is appropriate. Together with our cash balance, it gives us pro forma at 30 June 24 access to in excess of $2 billion of cash and debt in terms of total liquidity. As it relates to covenants, they are confidential. However, they are materially more favourable. And you picked up a particularly key point, and that is that covenants on the existing facility, and particularly the leverage ratio, will decline over FY25 to gross debt to EBITDA of 2 times, which is fairly restrictive. This facility has a net debt to EBITDA leverage ratio, which will take into account our significant cash balances, so is significantly more flexible on that basis.